This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode is with someone who is running the long race. We sit down and run with prolific long-distance runner Ivan Zinn, who's been a pioneer in alternative credit and asset-based finance. Ivan has had a long career in private credit. He started at DLJ before joining Leonard Green Partners and Highbridge Capital. He then joined HBK before founding pioneering private credit firm Atalaya Capital Management, where he was also the CIO. Ivan and team grew Atalaya to over $10 billion in AUM from 2006 to 2024, before being acquired by Blue Owl Capital for $450 million and $800 million if you include earnouts. As part of the transaction, Ivan became a managing director at Blue Owl and is the head of alternative credit, where the firm is now expanding its footprint due to Atalaya's expertise. Ivan is as prolific outside of the office as he is in it. He is a long-distance runner running 100-mile races and was an NCAA All-American tennis player, which comes as no surprise given the discipline, focus, and expertise required to excel at the activities he's done throughout his career in both work and sport. He's also a board member of the USTA Foundation. Ivan and I had a fascinating conversation about the evolution of private credit and the growth of asset-based finance. We discussed how and why ABF has grown within the private credit ecosystem, ABF's market structure, and a trip down Main Street, the potential size of the ABF market, why moving assets off bank balance sheets can help the financial system, why private credit is a data-rich asset, where ABF fits into a portfolio, and why consumer credit is potentially misunderstood within private credit. Thanks, Ivan, for coming on the show to share your wisdom and expertise on private credit and ABF. And good luck to anyone keeping up with you on a run.
In a collision of culture and finance.
We're going mainstream.
Ivan, welcome to the Alt Goes Mainstream podcast.
Well, it's great to be here.
Well, great to be here in Blue Owl's offices. I'm sure we'll end up going for a run at some point too. But
Right after this.
I want to start there because I think there's so many parallels between the ability to go the distance, not just in running, but in business. And I'd love to just hear how you got into that,
Sure.
how you thought about it, how you ran this 100-mile race.
There's plenty of similarities. One of those is some of the cumulative buildup of expertise in the case of investing in business. And then for running, you can't just kind of go out and run a long distance by any means when you're either not up for it or haven't built up miles and miles. And the other parts of things like resilience, where I always joke about any race that I've ever done, whether it's a 5K or a 50 mile or longer, at some point, probably 2/3 or 3/4 of the way in, you think it's a really horrific idea and you want to stop. But that happens, obviously, every race. It doesn't matter what it is because you're having to struggle through whatever that is. And I think there's a lot of elements of sports in general, but running in particular, because it's this singular endeavor where you're doing something that largely doesn't make a ton of sense, or at least it doesn't feel like at the time, but you keep going and you obviously have to build up to that. And there's a lot of physical, but also mental and psychological parts of it. So I think those are probably the biggest, or the easiest parallels to draw between the two.
Well, you've done something similar first in founding Atalaya, now becoming part of Blue Owl. And also that's mirrored a lot of the evolution of credit. So would love to start there in terms of the long race you've been running with Atalaya and now becoming part of a bigger platform and what you're building in the credit space.
Sure. Well, I can start even a little before Atalaya. When I started doing private credit, we didn't really call it private credit. We didn't have a defined term of art, if you will, in the early 2000s. But at that time, myself and then now a number of my colleagues at Highbridge doing it there was Cerberus had really started it and kicked it off a number of years before that. Silverpoint and Fortress show up, and I joked that the terms were LIBOR plus 1,000, no negotiating, and that was really the deal. Of course, that was a long time ago, and private markets were just forming around this. We were competing with Goldman's prop desk and with occasionally other prop desks and GE Capital and people that weren't banks, but who are obviously lower cost of capital. But we managed to, because it was early, be able to provide something that was different and outside the banking system. And this idea at the time, some would say shadow banking, became much more developed pre-08, i.e. adopted by a modest number of sponsors or a modest number of borrowers. But of course, the GFC happens. Most of the capital had been raised in that landscape were, call it hedge fund-like things, whether it was called a hedge fund or not, but it was hedge fund-like. 08 happens. The survivors that were able to kind of come out the other side, at least in our case, we flipped our hat around and started buying all these asset classes that we had tried to be lenders against in the past. And because GE got carried out, obviously asset liability matching problem, Capital Source and Textron and others, a lot of the natural competitors were out of the system. Of course, banks were out of the system. We really started to flip our hat around and started opportunistically buying all these asset classes, trying to figure out how do you service a bunch of truck leases or copier leases, or how do you buy these consumer loans and either lend against them or buy them. So we are really, when I look at the Atalaya business and the evolution, we, at some level, post GFC, slightly took a different tack or track, which is to focus not on corporate direct lending. Now, at the time, we thought there was going to be more competition, calling on smart financial sponsors who were going to beat you up on terms. That was all true, but it just happened to be that the market evolution was that all this corporate credit came out of the banking system and went into private vehicles, and it came much quicker and faster and bigger than anyone really thought at the time, right? That there wasn't a $1 billion transaction in 2010 or 11 or 12, and then all of a sudden now, 12, fast forward, there are a lot of them. But we were at some level toiling away in this asset-backed and asset-based world and doing some other opportunistic investing, of course. And what we realized is that, of course, it was great to buy assets at big discounts from FDIC failed institutions, but it was also, some of these had risen out of the ashes of the GFC. They'd proven that they were good at creating whatever asset class it was, whether it's equipment leases or a credit card or otherwise. And so we could finance them at pretty attractive terms because there was no other money for it. And then at some point they said, we don't like your expensive money. How about something lower? And we developed this fund to do lending against these assets exclusively. So at the time, we weren't smart enough to realize that people didn't just want the most expensive capital, but they would show up and ask for the lower cost of capital. But it really became not just a graduate program for people coming into our lower returning vehicles, but that really was for us I'd say the next phase was having either opportunity to buy or opportunity to lend and have slightly different cost of capital. That really for us was a real growth driver because the marketplace then continued to come our way in terms of more people needing the capital, banking system obviously continuing to basically not deliver that. And then near and dear to your heart, the fintech overlay, if you will, really got going. For a long time, we had to choke the word fintech out when we'd say it because we weren't true believers. But I think today, I think it's really accepted that there's great delivery vessel or pipes that do things that you otherwise couldn't do. And whether that's originate credit or evaluate credit or collect on credit or otherwise, all those really are different and had been transformative, not in the way that maybe people thought they were, that they were going to destroy all the banks, if you will, but different. And I think those concurrent themes of really some of these winners that we had been financing, winning and growing and needing more capital, we like to talk about as one of the few places in credit where the winners run. And the other element of that is having the fintech growth engine, if you will, things like fancy venture founders or funders kind of coming in and throwing a bunch of equity capital into things that we'd never seen before. I think that happened in 2012. It was the first time we financed something where was a fancy venture investor, and we go, oh, this is great. They actually are well capitalized and they're financing all these loans with equity, and we can facilitate that. So those were some of the main drivers. Of course, the 22-23 era really was the final, I'd say, inflection point. Why we think asset-backed and asset-based activity has become much more topical was this 22-23, where rates go up, banks, where they were, I would say, tourists in things like equipment leases or buying loans from fintechs, because when your borrowing cost is zero, everything makes sense. When rates go up, you exit all those things. And that's where we've been able to say, no, we're a long-term stable source of capital. Yep, our cost of capital is probably greater than a bank, but we're not going to call you and tell you to rip up your loan agreement, or we're not going to exit just unilaterally because the deposits were all running out the door. So I think that was really the final for the asset-based part of the story. And for us, of course, in the meantime, corporate direct lending has been growing and thriving and replacing and privatizing all of corporate credit. And we think that's why we're at the early stages of that growth trajectory for the asset back. So that's why it's like a topic today, despite us yelling next generation of private credit for the last 10 years, we're early, but we like to say early but right.
Really interesting overview of all these evolutions. I think the fintech piece is a really interesting one, in that fintech's kind of caught up to the size and scale of all the large private credit players. So I want to get to that. But first, I think there's a really interesting conversation to be had around pre-GFC. There was obviously an opportunity in private credit. Post-GFC, there's also an opportunity in private credit, maybe slightly different because of some of the structural changes post-GFC. What did you see pre-GFC that made you excited about private credit at that time, maybe not knowing what the structural changes would look like over time?
Yeah, I don't think a lot of us saw the structural changes, and the structural changes were absolutely magnified and accelerated by the GFC. So hard to say what the other door would have looked like had that not happened. But I don't think we're thinking about it at least certainly I wasn't, young and dumb, but at some level it's saying we can go make credit ourselves and we can go originate it, and whether that meant directly in some cases sponsors, or in some cases like calling on companies, or in some cases through small intermediaries. We used to joke that our favorite types of deals came from an AOL email address, so not well intermediated. But some of the view was we can manufacture extra return by doing it ourselves, like better covenants, better terms, more spread. We don't have to get disintermediated. So that was the essence of the pre-GFC trade, and do some things that banks wouldn't do, for sure. Now, the GFC changed that radically because there was a lot more that banks wouldn't do. And a lot of the corporate credit really got pushed out of the system with the leverage limiter. But then, frankly, the banks were so hobbled that they were also not doing it. And of course, the regulators trying to get risk out of the system and getting it to a more distributed place or diversified place, which is, like I'd say, largely worked. And so I think the thing that we saw a little bit of with the benefit of hindsight is that one thing that we observed, for example, early days, we would just do effectively what today would be called unitranche. There would be no other lender. And then at some point you'd partner with Foothill or Wells Fargo Foothill or CIT or somebody else, and or GE, and they do a first out and you do the second out, and you'd still get your LIBOR plus 1,000 that I was joking about. But that was a pretty expensive and difficult form of like negotiating with that first out. And so what became really impactful a little bit pre-08 but a lot after '08 was this middle market CLO technology, which is just doing a bunch of effectively unitranche deals that allowed you to really reduce your cost of capital, which made you much more competitive with, let's just say, sponsor finance. And so the beginnings of that took place, and those were largely, they worked in the sense that the cost of capital was lower. It was a better structure for the investor, but better structure for the counterparts to control your destiny. And so I think that was actually one of the important developments as you look post GFC, where once the engine started going again, that started to become much larger. And so you could do larger deals, you could control more of the capital structure. And so over time, it was a competitive, effectively, source of capital. Now it's still a little bit pricier than, for example, a term loan from a broadly syndicated deal, but you could rely upon one counterpart to do that. And I think that's what we saw and have benefited from in the asset-based and asset-backed side, which is this idea that they want to know who their lender is, and they want to know that you're good for it, because we're deeply embedded in these ecosystems. Like, we're really the oxygen for these businesses. If they're making loans, then we got to be good for it in terms of providing that capital to them, because they need to be good for it. And it's more important that they have a trusted counterparty. And so over time, we realized that we need to be that one, be more, let's just say, relationship oriented, that we want to do a lot of repeat business, similar to the corporate world, where there was not a lot of thought about repeat business in 2003. It was more, how much can we extract? And over time, it became, we want to do repeat business. We want to do and make good returns, but at the same time, we want to continue to do good business and have them come back to us in whatever format that was. And so that was certainly an evolution that we adopted. More importantly, as you look down the road from where we are today, we think that that same evolution, i.e. having the right cost of capital to grow with people, to be able to do a bunch of different things, has been critical to our business up until now, and will be even more critical going forward. Because to your point earlier, like, the size and scale of these things is growing. And of course, some people are going to be able to take our capital at some double-digit rate of return, and some people are going to say, no, I have earned my way down to something that looks more like a securitization, but we want to privatize, if you will, all the things that were otherwise done in the ABS market or in some cases the banks, but to really be able to do that and essentially hold that ourselves. So that's the trend that you saw in corporate credit, which we're seeing, we're admittedly behind and lagging, but now accelerating.
Related to that, though, you mentioned something earlier, which is interesting, which is that obviously the banks have retrenched post GFC. Yeah. On the asset manager side, asset managers, I think, understand and make the argument, which I think is a very valid one, that moving certain assets off of a bank balance sheet and into the private credit marketplace may actually be good for the ecosystem. And we can get into that, because I think that's a worthy discussion to have. But do the borrowers understand, or the origination platforms, did they understand that too? And is that why they're coming to private credit firms? Because they know you will be certainty of capital. They understand that moving that off a bank balance sheet might be good for everybody as well.
So it's been a evolution of their thinking too. But every time that you have some volatile period, and I'm not even counting the last 6 weeks at this point, but some volatile period, we've seen that the originators of this assets go, I need a better longish term solution. I can't rely upon the securitization market. Securitization market's going to be open and it's going to be shut. And then if I'm originating credit, I can't just hang out and wait for months or longer till it opens back up again. And so whether it was COVID, rate cycle, even most recently, the idea that you need at least some portion of your capital. Now, in some cases, maybe you need a couple legs to your stool, but at least one of those legs has to be a stable source of capital. And stability, I think we've seen, it comes from not being, for example, reliant upon deposits and not having, and we saw this during 22, 23, right? Where myself, maybe you, are trying to get your money out of First Republic or Silicon Valley Bank as fast as possible. One, because you were taking unsecured credit risk, and two, you wanted to make more than zero, which is what they were offering. And so we moved deposits out, but everyone else did too. And what really that showed, and we have some discussions with the next regulators, that the velocity of deposits in the banking system was way faster than anyone ever thought. Back in '08, it was tough to get your money out. You might have had a banking app on your phone. You were maybe cashing a check that way, but that was about it. And so that wasn't a great proxy. And so when 22, 23 rolls around, I think everyone realized that banks are, I'm going to say, more risky in terms of at least the liability side of their balance sheet. And so we've just seen and in fact, I think Morgan Stanley has a good slide I've seen that they've produced, which says essentially the de-lending of banking, which is this idea that banks are going to try to be shorter dated with their loans, but they're going to try to do as little as possible. And by the way, the regulators, all things being equal, would be totally happy with that. They want to have the most boring banks possible. They want banks to do business with people who are depositors, people who are already. So I think the idea there is that getting out of these assets off of bank balance sheets, going back to the Dodd-Frank and beyond, it worked, right? It de-risked the banking system. The leverage came down. The banks were less risky. And then fast forward, you see it continue to work in every step of the way. If you were a originator of credit and you needed cash as your oxygen, you should have said, I was scared during COVID, or I was scared during the rate cycle, and I need that certainty. So just like private equity sponsors, I think have a appreciation for, which is why I think the numbers are roughly half of the addressable market that could go to private credit and corporate does. In other words, they have about half the market share that they could. We're at the very early stages of that in the asset-backed world, because historically, I think there's been a lack of either understanding or an adoption, or banks were still doing some of it off the side of their desk. And that's the trend line that people are looking at and staring at and going, this is going to be a really big opportunity. So I think your point about people who are in the origination business are getting it, I think, more slowly than we would like, but they're definitely getting it. And every time you have these shock to the system, more people understand it.
Will it be distributed the same way that it is? Because it feels like scale is a feature of private credit and capital is aggregating to the larger firms.
Yeah.
What does that do to the ecosystem?
I think it's a reasonable point. If it all ended up in 4 people's hands, then you'd probably end up in the Wayback Machine where their banks were too big to fail. But at the same time, even that, Blue Owl and other asset managers, it's not like that's just in one fund. That in of itself is distributed to many different underlying either funds or then ultimately investors. So I don't even think there's a great monolithic answer to like Blue Owl is 100% market share, therefore it's more risky. Conceivably, that'd be distributed into many different hands. So I think you have a reasonable point, which is if it was too concentrated, it's more risky than much more diversified. But even the concentrated isn't concentrated in the context of, hey, you're JP Morgan. JP Morgan's got a massive amount of assets and a massive amount of short-term liabilities on their side, and those may not be matched up. So I think it's certainly better than the banking system, better than what we've had before. But only in some extreme concentration scenario, I think it actually gets to the risky stage.
Well, I think you bring up a really important point, which is private credit is a lot of different things. And ABF is just one thing within the broader private credit universe. I would love to unpack the definitions of ABF. You referenced it a little bit earlier, but there's asset-based finance, there's asset-backed finance. We'd love to unpack that because that in and of itself is one piece of the private credit universe, growing one. And then not only do you have corporate ABF, but you have consumer ABF. And then so there are really a lot of differences and nuances to this space. So I'd love for you to unpack all of this.
I'll try to do a little bit of a broad-based generalization in terms of the categories, because no question, corporate credit in of itself is a lot of things. It could be larger cap, it could be a smaller cap, non-sponsored, other flavors of it, but they taste a little bit more similar. And I think the struggle that we've always had is explaining what is asset-based finance, because in asset-backed finance, like, is it music royalties? Because that's a very different thing than a credit card. And packaging it all under one moniker is, of course, the challenge. And those are pretty radically different things in terms of how good they are as investments, but also understanding them. So I think that investors should, some level, endeavor to recognize that one of the good parts about something like asset-based finance is that it's a bunch of different underlying asset classes. Now, we find that there's a handful of things in there that get distracting, whether it's the music royalties is one thing that everyone brings up, and it's a tiny fraction and probably not that interesting, but everyone likes to talk about it. So I think that we would look and say more broadly and say, of course, there's real estate credit, and there's many different flavors of real estate credit. And those are at least asset backed by, call it definition. There's infrastructure, there's private corporate credit, there's many different flavors of this. And I think in a future state, like private equity, like other forms of capital, private or public, you'll have verticalized specialties, and people are good at that. And then you'll have people that are broad-based, and you'll have some multi-asset solutions, and you'll have some very specific solutions. And investors will be able to choose, I want all corporate credit, or I want this flavor of corporate credit, or I want all of asset-backed or this flavor. And so I think the future state will be much more verticalized, if you will. Now, we're not there yet. We're still at the early stages where people say private credit and they only think corporate credit. So, really the asset-backed, asset-based, let's spend some time there because that's obviously near and dear to my heart. I think we would say the real credit nerds would say there's certainly differences between ABL and ABF and what we're now calling alternative credit, which is even a slightly broader mandate. I think without getting into the credit nerdery, we'll just call them the same for the most part. Asset-based lending historically has been receivables and other forms of collateral that you'd lend to a company, but you'd lend against their receivables or inventory. Again, something that we would say, fine, not something that we're maybe as excited about, but certainly an asset-based. Asset-backed is really what I think is the meat of the opportunity in terms of trillions or tens of trillions of opportunity. And that we've defined it as either hard assets, so equipment leasing, and there's many different flavors of equipment leasing. There's really copier leases and truck leases and planes and much bigger assets, and including even assets that we've done and decided we don't like anymore, like shipping, too volatile, but you could certainly call that an asset-based, all the way to, in terms of those hard assets, there's inclusive of that, we define that to include residential finance. Some people might separate it because it's massive, but we put it in there because we think of it as backed by a house. The other flavors of asset-backed finance we'd put in there is really financial assets. We talked a little about this before, which is a small business and credit cards and other flavors of consumer. Those are where we focus our time and energy because we think of those as businesses generally. In other words, repeatable, scalable, not just fun to talk about, but also actually have a repeatable nature to it. Certainly there's other items in the, call it soft asset category, music royalties, intellectual property, litigation finance, all things that fit in the probably niche category where funds will crop up. Funds exist today. They'll be small. They won't be widely distributed. And people love to talk about whiskey barrel aging and other things because it's fun to talk about. So unfortunately, it's not a great succinct answer. And this is the struggle, is helping people define and demystify this. And that's in fact something we spend time with investors on, which is saying, no, you own this already. It's in your fixed income portfolio. It's in an ABS format, but it's not to the middle market size company. It's to American Express or some version of that.
I think you bring up a really interesting point because there's so many different flavors of credit. That also probably means there's different risk profiles to some extent. But there's also the public side of it. People own or have exposures to a similar category, maybe different size borrower on the public side. But how should investors think about their exposures and risk when you actually break it down to a more unitized or atomized level of private credit, given that it's not just maybe one piece of an investor's allocation, but it's actually a lot of different things?
Yeah, if investors had perfect transparency in terms of they knew that this fund had this amount of corporate credit and this amount of ABS and this amount of underlying ABS, what the flavors were, the look through, I think, would be interesting. I haven't seen tools that do that yet. Maybe we'll get there. I think that, again, people would be surprised that they own all flavors of all these things that we're talking about, maybe in incredibly small size already. But the biggest food groups there, whether it's consumer credit or residential finance or equipment leasing, those already, again, live in ABS bonds. And I think that if you kind of were to look through it, I still think that ABS and ABF have been underrepresented. But at the same time, that's the opportunity, and underrepresented because, again, they've existed in a securitized format, but our opportunity is to go and basically get more to the source of the opportunity and manufacture that more directly and deliver that in a way where people are actively choosing that as opposed to passively getting it from some bond fund that they have.
I think that's a really important point, and I want to unpack that. Some people have called it like farm to table. I think you've called it locally sourced. That's a really important point because it strips out fees, right? If you're going direct to the borrower rather than having it packaged in different ways, what does that do to the credit ecosystem, both for the borrowers, but also for investors who are investing in private credit as opposed to some more public form of credit?
Well, certainly there's a bunch of economics that are sitting there, even if, for example, let's just say a bond fund buys a ABS bond and makes a 6. That's not a 6% cost of capital to the credit card originator. That's probably more closer to a 9 or something a couple hundred basis points wider because the investment bank took its fee, the rating agencies took its fees. There's a bunch of other trustees and other things in the middle. And so there's hundreds of basis points there. So at some level, our goal is to disintermediate and take that by getting into it directly and making it directly, and don't necessarily need a rating. In fact, don't want one in large part, or at least don't need one. And so I think that we're capturing that for sure from a more direct sales. The other part is that if you need $100 million, the bond market does not care about you. Good luck. And it's not going to cost you a couple hundred basis points more. It's going to cost you a lot more because the fees are still the same and the rating agencies are still the same, whether it's 500 million or 100 million. So I think there's a fit problem too, which is that there's only so many things that can be effectively in the public markets. Of course, you see that in the public equity market today too, right? That people are going, I don't want to be a public company because it's too expensive and no one's going to care. Same problem. And in fact, if you're a bond buyer, you want to know that that issuer is going to come back not just once because there's no liquidity in that bond. You want to know that there's going to come back every quarter or maybe for the next 10 years. And so there's this real gap between what's essentially advisable to be public or traded. And yeah, we're trying to find the things that are, one, a little bit smaller, and two, where they understand that we're also good for it, whether it's 22, where the market's gyrating all over the place and we're still in business and still really trying to stand up to that. So I do think that as the kind of progress marches forward, the idea that we can kind of go deliver these and somebody can sign up for, I want that, I want asset backed, or I want infrastructure, or I want this kind of credit, as opposed to just kind of getting it passively.
As more capital comes into private credit ecosystem, does that mean returns will likely go down?
Certainly capital markets would suggest that. So I got to believe the answer to that is yes over time. And I think it's true at some level today that corporate credit, for example, the spread from, call it public to private over time has gotten less. And I can definitely say that the last 20 years, because it really was LIBOR plus 1,000 and it's now very rarely is SOFR plus 1,000. But I think the idea that there's still a manufacturing premium, just one from the returns and two from things like documents and structure, that's real, because if we do a deal, we're going to own that risk and we're going to have to live with it. We're not selling it down the road to somebody else. We're going to have to basically manage that risk, and we want to know that the covenants are tight and that we can manage through any problems that come up. So we got to negotiate something we're willing to live with, as opposed to something that's in the transactional atmosphere where you're selling it. So I think that certainly spreads have come down on the margin, and as more capital flows in, it'll come down. But also, I think it'll also provide a broader set of counterparties. And I think this is definitely true in private equity. I mentioned, for example, there wasn't $1 billion deal, and now there's lots of them. And if you were doing $1 billion deal 10, 15 years ago, you had to go to the high yield market and borrow the syndicated market because you couldn't find the money. Today, you can find the money. And again, they don't do it because out of the goodness of their heart. They're doing it because it's a better solution. And I think that's what we're seeing, that evolution in the asset-backed world, where for a long time we were looking and we didn't do $1 billion deal until 22 when that opportunity set came because of the rate cycle. But more importantly, it's because there was enough assets there. And so we're going to see the growth of the opportunity set. And over time, look, that certainly means the capital cost will come down. In some cases, it'll just be different funds. You'll have something that's generating higher returns and something generating middle returns. And then you'll have something that might be insurance related over here. And that's certainly what's happened in the corporate credit landscape. I actually think the reason why returns have probably come down more is insurance related than anything else.
Where do you think you need to have the biggest moat or edge? Is it around origination, or is it around things like underwriting, analytics, and managing portfolio?
If you don't see it, you can't do it. So I think that the starting point really has to be with origination, which is a lot built over, we think, a long period of time, because the counterparty risk is real. You need to know that your counterparty is good for it, understands what the heck they're talking about. But it's necessary to see the transactions. But we've seen certainly plenty of transactions where we thought it was fine, not bad, not horrible. It would have been fine, except for if anything bad, shock to the system happens. And the only way we can really look at that and say, here's what our analysis says, if there's a shock and you sensitize losses up 50% or up a number of percent, is you have all the data in the past. And you have a pretty good analytics tool that goes, this portfolio is not going to be the 13 that you modeled it, it's going to be a 4. And while that's okay, if, for example, the GFC loss scenario is you make a 4, that's pretty good. You're pretty happy making your money back in a little bit in some really extreme stress case. But what if it's only 10% worse or 20% worse than you expect? Then you have a massive return degradation. So I don't think it's easy to say it's one or the other. I think they're both critically important. But I do think that if you see it, then you can have the tools to it. If you just have the tools and you don't see any deals, then that you don't have no business at that point either.
When you think about the consumer side of credit, I want you to unpack that perceived risk versus actual risks. I think there's some interesting nuances there that get into how you underwrite, how you build origination partnerships. I mean, we're seeing many of these, you mentioned fintech. So like, the consumer fintechs, like the PayPals, the Klarnas, the SoFis, all of these firms are doing large either forward flows or facilities with big credit players. And these are big numbers. We're talking about billions of dollars, tens of billions of dollars. How should people think about risk in consumer credit and what that means from an underwriting and also monitoring perspective?
Sure. Well, it is one of the things that we do struggle with, because I think there's this perception of consumer sentiment is, let's say, right, this point in time is not good. And yet people then say consumer credit must be also not good. And we say, well, that actually maybe is contrary. People are essentially being more conservative over here. They're probably actually doing better at making payments over here. To be clear, their journal had I think an article the other day said sentiment's really bad, but the data doesn't show it. And we would actually echo that, which is sentiment's not great, notwithstanding last week where everything's up. Data doesn't say that. Spending, default rate, delinquencies, all that doesn't actually say that at this point, at least from all the millions of data points that we collect. But I think the important part there is the perception is that it's risky. The perception is it's highly cyclical. And historically speaking, it actually hasn't been true. We wrote a white paper at one point. Maybe we overdid it by saying, don't hype my Mount Stupid. But the idea wasn't by any means to suggest that the readers were that. But the idea was really to say the perception of this risk is just not right. In other words, the perception is riskier because I think people don't know better. And it's harder and it's complicated. And you're, of course, one single credit card versus one single corporate loan is more risky. But we're not talking about one. We're talking about thousands or tens of thousands or more in any given portfolio. And all of those streams of cash flow pay back principal plus interest. In the case of credit card, there's a lot of utility to that. You got to pay today's bill to get access to credit tomorrow. So there's a lot of utility. We saw that through the GFC. It's actually one of the better performing assets, surprisingly, I think, to a lot of people. But that utility function was a critical part of it because, again, you need access to credit and you are not walking around with a bunch of cash in your pocket. And so the thing that we show people is, look, first of all, again, we talked about earlier, ABS historically trades tighter. Historically, we can show people that essentially the resilience has been better. Now, the resilience comes from massively diversified portfolio and a lot of cash flow coming back constantly. And I think that's just, again, it's a complicated concept, one where you do need data science, where we've learned not to pull out the charts right away and make people's eyes glaze over because it's complicated stuff. And so we're hopeful that the proof is in the pudding by the performance, but also then ultimately by being able to show people over time. And we like to look at effectively, our standard analysis is, can this survive the GFC? If we buy a pool or lend against a pool of assets or small business loans or anything, can this survive the GFC like losses? We happen to have the data for a lot of these things. We can overlay that into our model. I think that's a surprising conclusion, but it's also something you can do well for corporate credit because the data analytics don't exist in the same way.
Do investors who are allocating to private credit, particularly consumer-focused private credit, do they have to have a view on the consumer or SMB to have conviction in allocating? Or are you saying there's so much diversification across these different types? And I in my head, I go to that great chart that you've put together on Main Street. It's like there's so many different pieces. You walk down Main Street, all these different things are related to private credit. Is there so much diversification in the ABF category of private credit that people may not need to have a view or conviction on the consumer or SME to make a decision to allocate, and it's actually getting diversification in a category that they want exposure to in addition to all the other parts of private market?
No question there's a bunch of diversification within ABF, but we would even say, you mentioned and started the consumer, which is, some people says, do you like consumer credit today? And we go, well, that's like saying, do you like stocks? We don't like all of them. We like some of them. And so we would say consumer credit has just been a place where you could scale and repeatable. And we've been really successful and done hundreds of transactions at this point. But we can point to what we like, what we don't like, why we like it, repeat success, winners. And so this goes back to, we don't like all consumer credit. In the same way we don't like all of any other kind of credit. And we would suggest that when people look at it, they're looking at not just, hey, we're not taking a bet on consumer credit, some macro call. The same way that if they're giving money to and investing money in a corporate credit, like a private corporate credit, I don't think anyone's asking them to make a macro call on, is it a good time to be corporate or not? In other words, they're saying, the manager is going to be good at selecting, I like this kind of company, but not this one. I like this sponsor, don't like this one. And so just like investing in corporate credit or real estate credit or asset-based credit, the idea that you have to have a strong conviction that it's a great macro period, I think is false, because you're ultimately relying on the manager to know what they like and don't like. And so we think the simplest analogy is this idea that, no, of course we don't like all consumer credit. We like a bunch of different parts of it. And certainly you're seeing the scale and size of it. You mentioned some of these large announcements, and that's exciting to us that a lot of those are done with private market investors. These aren't big announcements to say, hey, I'm selling $5 billion into the ABS market. These are much different. These are doing transactions with people that look like us.
We've talked a lot about the manufacturing side of private credit. I want to talk about the packaging side of credit to investors. So first, I want to start with Atalaya and your journey to joining Blue Owl.
Sure.
You built Atalaya into one of the top independent credit firms, particularly in the ABF category, grew to $10 billion. Blue Owl then acquired you recently. Walk us through that thought process of why join a larger platform.
Well, I think we as the business was growing and it had success, I think we, at some point, realized that $10 million wasn't a big firm. When we started, it was a big firm, and years later. And I think we really did, certainly with the 22, 23 change, it started to feel a little different, i.e. feel more topical, feel like people were coming directionally our way. And we look at our own tools, we said, well, we've been okay at institutional fundraising and capital formation. We've really struggled to do anything with insurance companies, not zero, but not a lot. We found it very difficult to be on the other side of the table and manufacture and figure out what they liked and didn't like. And everyone wanted a different flavor, and we couldn't figure out why. So we've done very little there. And we've done also very, very little in the private wealth channel. And so we looked and said, well, can we compete down the road? And we felt like we were going to be able to compete from an investment perspective. We thought we were more innovative in areas like data science and more innovative in other areas. But if we didn't have the capital or the right capital, that we were going to get run over. And so we got phone calls for a long time from various people, and for a while it was flattering. And then at some point we just said, gosh, we're going to not spend our time here. But more importantly, the world, I think, continues to evolve, where there's these pillars of capital you need, where you need the institutional investors, you need something that's insurance related, and you need the private wealth. And we looked and said, we can't really do the private wealth thing well. And we had one person doing it, and we did well for one person, but we didn't have 100 or 200 as the case at Blue Owl. And we basically had almost no insurance-like relationships of any meaningful import. So, and that tends to be the lower cost of capital, which we talked about earlier. And so we looked and said, we're not going to be successful long term. And so it didn't feel like we needed to do anything urgently by any means, but it did feel like the world was changing and going to keep changing. And that's true. Even in the last year, we could see that evolve at an even more rapid rate. Like the number of people who've launched varying forms of evergreen structures in any kind of asset class is, my suspicion is it multiples of what it's been in the previous years. And we see that and observe that. And we didn't have all of that necessarily perspective, but we knew that it was coming. And again, I feel like we were right in the sense that that is evolving even faster than we thought. So for us, it was a matter of saying, are we going to do something? The answer is yes. And so in the case of Blue Owl, we were really very comfortable with the organization. A lot of people here, they didn't do what we did. There was going to be no conflict. There was also going to be an easy kind of integration where there was not going to be a lot of overlap of what we did. And I think importantly, it was a Goldilocks size where it was big enough to have those resources that we didn't have, but small enough where we were able to have some impact and have some impact, not just on the growth of the business, but hey, what should data science look like across the platform? How should this work? Can we influence that, as opposed to much, much larger organizations where we felt like we would have disappeared and never to be heard from again. So that was really the backdrop for what we did. And I think you've seen that steady drumbeat of people doing transactions even last year. I'm sure it's continuing and will continue as we go forward, because I think $10 million is not very large. And I think when you look at people who are multiples of where we were, they're worried about the same thing. Can they be public? Do they want to be public? Can they not be public? Can they compete for some of these things? I think that's real. And these are firms that we kind of looked around the road and said, well, if we double, triple, quintuple, we're going to still worry about these same things. Why would we want to go through that? Why don't we make sure that we're one of the winners? We have these incredible sourcing, origination, execution, and all the analytics associated with it. We need to really make sure that we are winners with those tools.
One of the other things embedded in what you just shared is the importance of DNA and shared culture in terms of how you think about running a business, particularly when it comes to credit. You have to have a pretty similar view of underwriting, I think. So how did the two DNAs and shared culture mesh together? Because that's so important in credit, is having a similar mindset.
The roots of Blue Owl, of course, are from the Owl Rock days. It was a credit business. So I think you can look, and today credit's still it's the largest business, and obviously real estate business is growing rapidly as well. But even a lot of what we do in real estate is credit oriented. right, where we're taking the credit risk of an investment grade counterpart. We're really relying on them to be good for it. So there's deep credit DNA across the firm, whether it says credit or says real estate. And we take some comfort from that and take some comfort from some shared, not just perspective, but shared the entrepreneurial nature of Blue Owl, I think, is something that I appreciated, that having built Atalaya from scratch and having gone through all the trials and tribulations associated with that. And then you have Doug and Craig and Mark and others kind of come together and basically have built these other businesses and now ultimately bring those together that truly are operating as one. And we were ultimately had to spend time saying, are we comfortable putting the Blue Owl jersey on? And our answer to that was yes, that we think that the way these things work the best is not a hedge, like a 51% deal, a 2/3 deal where you're 1 foot in, 1 foot out. For all sorts of conflict and other reasons, I think it works best when you go, no, we are going to do this together. We believe, we're putting the jersey on. By the way, we continue to make investments the same way, same investment team, same investment committee, same investment process. It's open to everyone to join, but we're still doing it the same way that we were doing it before when it comes to investing. But all those other things we need and want help on, and we want people. And by the way, we want the benefit of the Blue Owl umbrella, i.e. the sourcing engine. We've joked a little bit that like nobody cared when Atalaya did a press release. And then when we started doing them at Blue Owl, everyone cares a lot more. And so that's real. And so I think we absolutely opted into that, but we thought we were going in eyes wide open. We thought we were going eyes wide open to the right culture because we knew so many of the same people. We had that shared history and DNA of certainly the credit and cultural, the entrepreneurial mindedness. And I think we also took some comfort from the success of the Oak Street transaction. I was an Oak Street fund investor going back pre-Blue Owl days, so saw what happened to that, could speak to Mark Czar. And I think all that coming together is what made us comfortable. But these are hard to get done. And I've had that discussion with somebody here even afterwards. Like these are hard things to get done, hard things to bring together, hard things to make people really row in the same direction. But we did that really purposefully. And I think a lot of these are maybe more rickety in terms of whether they're going to work long term or not, because I'm not sure that people are all in.
One of the other aspects of this too is being able to work with the wealth channel. Blue Owl has built an incredible business working with the wealth channel across the different strategies within Blue Owl. And I think that's another piece of all of this, which is it's interesting to think about private credit within a wealth investor's portfolio. How should a wealth investor think about private credit, and why should it be a part of a portfolio?
I think at minimum, it's the same way any other investor, private wealth or otherwise, it's a fixed income replacement. Hopefully you earn a premium to what you would in a regular way, bond fund or otherwise. And so fixed income replacement is first, has to work for that. Second, the question is, at least from a delivery vessel, how long are you locked up? Are you locked up forever? You can get your money back or your capital calls. There are things that private wealth worries about and should worry about. Certainly I'm on the other side of this too, which is the headache of it. Capital call, drawdown, pay attention to it, 10 years, don't get rid of it, all those problems. I think that what we've found is these semi-liquid delivery vessels, BDCs, REITs, interval funds or otherwise, are certainly a viable, and they've proven to be good, notwithstanding the various reservations that people had a long time ago. I think today we would say it's generally worked, just like private credit's worked. These delivery vessels have worked. And so if they can be that fixed income replacement where people pick up hundreds of basis points of return and are not trading off liquidity forever, people should seriously consider that as a meaningful part. And of course, we're by no means the only ones saying that. Lots of people will say that, and you're seeing the adoption of alts, but certainly these vehicles for that reason, 1099 and all the other delivery vessels make it much easier. So I think at basic level is, can it be fixed income replacement, and is it a headache? And if it solves those two problems for private wealth, then they should consider, is it just one flavor or is it multiple flavors?
If we combine what you just said around the ability to potentially rebalance or take capital out of these evergreen structures with something you said earlier, which is that there's more and more transparency coming to private credit around data and analytics. What is the impact of that market structure evolution from a technology perspective? And what kind of impact does that have on LPs and their mindset, do you think?
Transparency is good in general. No, I don't think anyone's going to sit here and go, transparency is bad. I think all of us are going to be fans of more information and more transparency. I think the idea that people are going to trade these things around, I think that's part of the question you're asking too, is should there be better pricing and market checks or otherwise? I'm not convinced that anyone actually wants to trade this stuff. Well, for a whole bunch of reasons. One is we tried to buy stuff from every BDC throughout the GFC, and we got a total of one trade done. It was from somebody who was liquidating. So that was one particular period of time for maybe 10 year period of time. But more importantly, I think that the private equity sponsor or our borrowers, they want us to be the counterpart. Like the whole idea of a private equity firm doing a corporate direct lending deal, so they know who their counterparty is. In fact, as you probably know, there's all sorts of, call it gray lists or blacklists of people who they can't do business with or won't do business with, and they don't want them to hold that loan. And so even more critical for kind of our capital, where you have to be good for the capital. So I don't think that if we did a deal and chopped it up and sold it to 10 people, that's what our counterpart wants. And I'm not sure that that's better for us. We want to eat what we make, and we want to try to use as much of it as possible. We're doing the hard work and finding it. So I just don't know who wants to trade it, other than the idea that you get a mark. I think I understand why people want a mark, and that might be a signal of if it's good or not good, right? I understand that part. But I also am not convinced that the mark does much. Look, maybe if you're an insurance manager, you get more regulatory credit because you can show that there's liquidity, so you have less regulatory capital charges. Maybe that's the reason. But I'm not convinced there's anyone who really is looking to trade this stuff, because if you're good at making it and you make a lot of it and you have the capital, you want to keep it. And there was a time many years ago when capital formation didn't keep up with it. Like 2003, you'd sit there and go, instead of one $50 million deal, I'd like 225s, and you'd figure out how to chop things up. That's not true today. In fact, the opposite is true, where you're trying to find more. So I just am not convinced that people really want to trade this stuff. It's not great for the counterparty. And I don't understand why people would want to necessarily sell it to others, if you will. Having a transparency of a mark is obviously a little bit better than not having it at all. But again, I don't think that people are coming in and saying, hey, I need a third party like trading mark to do that. It's also, even if you found, a mark and you could have it trade once, does that mean there's liquidity to it? Not really. So I'm not sure what the objective there is. And I don't really agree with the idea behind it.
What do you think is the next biggest thing in education, particularly of investors who are maybe earlier in their exposure to or understanding of private credit?
I do think that from our experience now, certainly as part of Blue Owl, there's a lot of effort going into the education, certainly into the private wealth side of the equation, which is educating, whether it's the larger wirehouse or RIAs. There's a ton of material getting produced, certainly white papers or otherwise. I think that at some level, the financial advisors at the root need to basically be convinced that it's a good fixed income replacement for somebody who's never had any alts before. So that's probably the front lines. It's the really, call it high net worth, ultra high net worth folks have probably been doing some flavor of alts for a while. Think that this is a good fixed income replacement, right? It's maybe not that tax efficient, at least certainly in the case of corporate direct lending and some of our ABF strategies. But I do think that at some level, that's the educational piece where we need to be able to get to the people who have done none of it and say you should do some of it. Now, the question is, what convinces people? I think time. I don't think that there's some magic article or magic podcast necessarily that we can get it all the way there. But also experience, right? If we would say that historically now it's worked. A lot of this today we're talking about because it's worked, i.e. the private credit's done its job and other flavors of these have done their job and made a nice return. And so people say, I'd like some more. I just don't want the same exact thing. I don't want to double down on what I have. I want to diversify that out.
Where are we in that evolution within ABF? Because ABF has been around for a bit of time, but it's earlier in people's adoption of it within the private credit ecosystem. How much time or data and performance do you think is required for people to start saying, okay, yes, ABF is something we truly understand?
Well, it's going to happen more quickly than it's happened with other, let's just say, private flavors of credit. I joke, right, it's been around for a long time. I joke that 2,000 years ago, you could pay for today's seeds with tomorrow's crops. There wasn't a private equity sponsor transaction to do then. So this was very early asset-based finance was essentially that. Now, I think the comparable that you can point to is like lending against software and recurring revenue, which is 20-something years ago, we were doing it, others were doing it. Wells Fargo Foothill was doing a lot of it. This was in the early 2000s. And at that time, the multiples were really low. The private equity sponsors were few and far between that got it. But it was perceived to be risky because it was technology. And people said software equals technology equals risky. I don't like it. But those proved to be incredibly resilient. And then fast forward even to today, where you have dedicated large funds, including blowout funds, that all they do is lending against software. And by the way, those multiples are higher, at least if you looked at the pure financial metrics, higher than they would be a widget manufacturer. And so now that evolution's been shorter than 20 years because it kind of didn't do anything. And then it became very, very much a kind of well-conceived or well-accepted knowledge that it was a good asset class to lend against. So with that wind up, I think this is a handful of years where people can, from now, where people can say it's worked, right? I did this fund, it made its return, it's diversified, and it's, I'd say, big enough where people can point at it and go, it's worked. So I think instead of, let's just say software took, let's not say the whole 20 years, let's say the starting point was after the GFC. Let's say software took 10 years to go from being kind of something a small number of people did to something that was well adopted and had funds dedicated to it. We already have funds dedicated to asset-based and asset-backed finance. So we're probably, I'm going to pick a number, 3 years from really being able to look backwards and people going, it's working. Now, institutions could say it's worked because they've been doing it for longer, but it's still not well adopted.
When you think about private credit as well, it's roughly 1.7 trillion size market. Some say it's anywhere between a 20 to 40 trillion dollar marketplace, depending on which firm and also which assets. Let's use this in the context of your running acumen. You've run a 100-mile race before. Where are we in the private credit evolution more broadly, not just ABF, in that 100-mile race? What mile marker are we at this point?
Good question. So maybe I'll put it in real ultra running geek speak for you. So Western States is one of the races I've run. Mile 30 and change is Robinson's Flat. So I'm going to say we're early stage. We're in the 30% category in terms of the adoption. And I think it'll happen much faster. Unlike the rest of my 30 to 100-mile race, which I was getting much slower, not faster. We're going to see that much more accelerated from here. And again, because we've seen in corporate, we've seen other asset classes. So, we're going to call it somewhere in those early, maybe it's 30%, third inning, something like that.
Reading your account of your 2012 100-mile race, by mile 80, I think you got IT band issues. Where does private credit start to see some IT band issues?
It's a good question. I think with benefit of hindsight, there was plenty of issues that were at least lurking in the context of doing any kind of long race. I think more likely, as I said before, at some point in any race, regardless of the length, you're thinking it's a really bad idea. Look, I think private credit's gone through some of these phases where people think it's a bad idea. GFC, for example, is one where people go, wait a minute, I have all this private stuff in these funds. And at some level, it's about knowing what you're getting into. So it's about, I think the best corollary I would say is that you're always going to have niggles, you're always going to have issues, you're always going to have something that you're working through, and it's going to feel like a big deal at that exact moment in time. But this, unlike ultra running where there's some endpoint of that race, this is a journey without an endpoint. And I think we're going to continue to evolve, and we're going to be like, hey, my IT band issues, maybe I got to fix that thing. And I would actually say that all the evolution we're talking about today, evergreen structures, evolution that solved the problem that these weren't digestible for private wealth. Something is now digestible, not just private wealth, but investors more broadly. There'll be no other evolutions that exist. So I think that the cracks, if you will, or the issues, those have continued to come up. You go back to GFC, but more recently COVID, rate cycle, and whatever's in front of us. I think you're seeing that it's just the volatility every time that happens. The other side, if you built a nice portfolio and you have the right infrastructure, you pop out the other side and it's a stronger business. So maybe an unsatisfying answer, but ultimately I think that you learn a lot when you go through these, and you pop out the other side much smarter. In case of any races, I think you pop out much smarter, even if you maybe think it was a bad idea for a moment.
Sounds like private credit also needs to make sure it just has the right prehab and activation exercises and a good physio along the way. That'll prevent a lot of the big issues if you can prevent it.
Yeah, that
in the short and near term.
There's many analogies you can come up with, but that's certainly one of them.
And that it feels like that's starting to happen with all the innovation around data science, making sure people are underwriting really well. Yeah. Having scale, I think, probably matters as well.
Scale is a really important part of it. Again, we saw it in corporate world. We're going to see it in the asset-backed world, and there'll be others. Infrastructure, a good example, right? Talking about data center activity, where there's a massive need for CapEx there, not just the outside of the box, if you will, the real estate, but all the inside servers, the GPUs or otherwise. And that was something that was on nobody's radar 5 years ago. Right? No one would have identified that as a really great area. We've done some data center equipment leasing in the past, but it wasn't a massive opportunity set. And so these things will keep changing.
I think you bring up another really interesting point, which is there's different forms and flavors of providing financing. And you mentioned this earlier in the podcast that it's going to get more verticalized, but then having the ability to do multiple forms of financing. Data center example is one perfect example where one team might do the assets within the data center, another team might do the data center. It feels like that's going to become a really important piece of this, so that you can be a service provider to the borrowers in a number of different ways.
Absolutely. We're calling on counterparts today or potential borrowers that we knew existed, but we wouldn't have been able to get in the door. But in some cases, our real assets team has been doing business with them, or is doing business with them now. Our tech team has been calling on them for something else, and we can, if we do it right, bring it all together. We're seeing the beginning stages of that, but again, not that long ago, no one could write those checks. Wasn't even on our radar. So I think this all fits in, and I'll bring it back to you for your running theme here. Yeah. At Atalaya, we had something we called the 3 R's. One of those was relentless forward progress, this idea. But I stole it out of ultra running, which is this idea that you're taking one step in front of the other. You have to believe that you're making forward progress every day. You have to buy into the idea that you need to keep changing and getting better, whatever that means. And so this all fits in that category of trying to make some relentless forward progress.
I think that's such a great way to end this and kind of tie it all together, because I think when you think about the speed at which this space has grown, it's been pretty fast. Takes, over a 10-year period, you look back and you go, wow, there's a lot that's changed here, and there's a lot that a firm has grown. I mean, Blue Owl's 8-9 years old, right? I mean, when you think about another 10 years, what does that look like, right? And what's the space can look like? So I think that's such an important point to remember, particularly in private markets, when things take time, but they take time for a reason. But then you look 10 years later and you say, wow, this space is much bigger than it was before.
Yeah,
firm is
the opportunity set is dramatically larger than we ever thought it was, and not that long ago.
So my favorite question to end for every guest is your most favorite or interesting alternative investment that you've made?
There's almost too many that fit into the storytelling category. Having done, at this point, I think we've done almost 1,000 investments at Atalaya. Unfortunately, the things that I have most seared onto my brain are the ones that went wrong.
Spoken like a good credit investor.
Yeah. I've learned that over time, but the credit investors think about all the ones that went wrong, and the equity investors say, "Yeah, you win some, you lose some." Don't think about those anymore. That's what makes them good at that. So I think the investments that have been most memorable are those where we look back and go, we really knew all the pieces of the puzzle. Maybe one that sticks out, for example, we bought a pool of non-performing second liens, and we subsequently bought a bunch of them because we decided it was attractive. And all the stars aligned. We were working with the servicing partner who had been servicing already. They were putting up their own money. It was a seller who was definitely getting out of the business, somebody who had been an insurance company that wrapped it for a bank and kind of ended up with it. Again, nobody wanted this after the GFC. HELOCs were 5 letters, but a 4-letter word. So we're buying them at a single-digit percentage of par value. Non-performing, to be clear. And the reason why I think I look back and say, gosh, whoever sees these things again will do it even bigger in size. But we thought we were buying a stream of cash flows that were effectively a long dated, but we were actually getting, we underpriced it, but in a good way, the call option on home equity being worth a lot more. So we got this stream of cash flows. It was worth about what we thought it was, at least from a kind of a credit collections perspective. But the call option on the home equity being something of real value was incredible. And so I think that drove that, but it was really that downside orientation where you got this free call, if you will. And I think we, again, trying to build situations today where we get that stream of cash flows and then have some call options. That one just worked incredibly well. And we fortunately did a bunch of more of them. Can't do any more today because those are pre-GFC assets, but that's probably the one sticks out just as a prototype for all the others.
I think that's an interesting one to highlight just because I think it brings rise to the point of risk reward. And that every investment in public also, but certainly private markets, there's a risk reward to it. And I think private credit's an interesting example of where thinking about that risk reward, there are times when you can get more upside.
Yeah.
Other businesses you have here, like GP Stakes, another example of that, where there's a risk that you're underwriting, there's a reward that you're underwriting, but then there's potentially more upside. So I think that's an interesting framing of how to think about certain aspects of private credit where underwrite something, maybe hope something else happens, but you don't need it to happen for it to be a good investment. Well, this was a great conversation. Thanks so much, Ivan.
Appreciate it. Thanks for taking the time. It was really fun.
Likewise.
I look forward to a run.
Same.
Okay.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going